It's now time for a fund manager's take on Brexit and all the developments around it. Philip Carden is portfolio manager of the Supervised High Yield Fund from Supervised Investments Australia. He joins me at the desk. Hey mate, how you going?
Good, thanks Peter. How are you?
Very good. Now, before we start talking about Brexit, just tell us what your fund does.
Okay, well, our fund invests primarily in international debt securities, in Australian debt securities. We are an Australian dollar-based fund, so where we buy securities in foreign currencies, we will always hedge the currency back into Australian dollars. And we'd only ever buy foreign currency bonds where we see those foreign economies performing better than Australia. And that really hasn't been the case since, apart from sort of the re-emergence of...
So you're forced to trade at home then, are you?
Well, we're not forced to. I mean, it's easier than staying up all night. We do have some US assets in the portfolio, though, because we see some good strength over there.
Did the potential of Brexit make you worry about doing anything in the UK?
I wasn't so concerned about that, but the potential of Brexit worried me about volatility. So we, for instance, in managing the fund, purchased a long volatility position earlier in June, and as it turned out, the result came out almost reverse what the market expected, and that did pay some dividends to us, but that's a sort of a one-off thing. That
Explain to my viewers, because we throw around those sort of terms, but you say you bought a volatility position. So explain what you mean by that.
Well, we bought puts and calls at the money on US 10-year Treasury bonds because we didn't really know which way it was going to go, but we thought it would be volatile.
So it's like insurance either way, isn't it?
That's right. Insurance if it goes up and insurance if it goes down. And the insurance is more valuable the higher the volatility becomes. And as it turned out...
And Friday was a high volatility...
Well, it was a dream come true for someone who had that kind of view on the market, yes.
If the volatility was really small, could you potentially lost a little bit in taking out insurance?
Yeah,
and that's a lot of people don't understand it. People like you can't afford not to take that kind of insurance out when you've got pretty big positions.
Well, we have positions in high-yield corporate credit and in residential mortgage-backed securities, and where markets lose confidence, as we know, they rush to safe havens, and sometimes the price of those investments can be undermined. But that's always associated with volatility. So the volatility hedge, as we call it, helps protect us from those other risks, market price risks associated with the portfolio we hold.
Okay. So for people who understand why they might want to work with you, describe the kind of typical client that thinks, yeah, these guys, I'll give them a bit of a go.
Well, I mean, I'm a client of myself, and my partners are too, so they'd be pretty much like us.
It's good to see you actually believe in yourself.
But I think they're pretty much like us. We've come over the hill, as it were, saved quite a bit of money over the period of our life, and we're looking for a place where we can invest money for the medium term that will throw off a good income, have a low level of capital price volatility, and where there's a conservative manager who will invest in securities that will repay 100% of their principal and interest, which is the case with our portfolio because we stress test our investments.
So this might be a weird question, Phil, but I think one of my viewers at home might be thinking, so, well, to me it sounds like a little bit more risky than an annuity, but more rewarding than an annuity. Is that a fair call?
I think it is a fair call. There's an annuity, in a sense, the person issuing the annuity is borrowing money from you, the buyer, and lending that into the market and taking a margin. Now, we take a fee, obviously, to manage your fund, but I think our fee's probably, we're probably lower than those margins in the annuity market because there's fixed-term annuities and whole-of-life annuities, and with the whole-of-life annuity, you've got that big mortality risk associated with it, and with extended mortality we've experienced over the past 20 years, some of those risks are quite expensive to hedge.
Okay, now you've got a chart here. Let's get it up, and just tell us why you brought this along. What is it actually showing?
Well, we were thinking about the implications of Britain exiting the EEC and why that might be viewed in a negative sense in the world, and really the EEC is a blend of the growth rates of all of the companies who are members, and we can see here the yellow line at the top. We've indexed it back to 2008, and we can see that the British economy is the best growing economy.
Now, which one is the Brits?
The line at the top, that yellowy line at the top that goes to 107.
Let's call it orange.
Orange, and then below that we've got Spain, and then we move into the lesser growing economies, Portugal, Italy, and excuse me, and France.
Yeah.
Now,
But where's Germany?
sorry, that second line is France.
Yeah, and Germany?
Well, we haven't put Germany in, but Germany would fall in between the UK and.
Okay, so what is then your view of what happens to UK growth, and how does that change the way you might invest?
Well, we invest for value. So, excuse me, we
Have a water, mate.
I caught a flu.
This is a relaxed program.
Brexit did give me the flu.
I recently choked on this program too, but didn't have a glass of water to help me out with. Go on.
So, look, we invest for value. We're not really concerned about the outcome of Brexit. What we're looking for is the best performing economies that we can identify in the world within our universe of investment economies. Britain doesn't fall into that at the moment because of the uncertainty associated with exiting Brexit. However, that includes Australia and also at the moment the United States of America. We feel quite positive.
So Australia and the US you're comfortable with in terms of growth outlook?
Yes.
Now, you might have heard my good esteemed colleague Steve Keane being very negative on the Australian outlook. Well, what is your response when you hear that kind of analysis?
Oh, well, we don't... well, I'm not as negative as that. I did hear what he had to say.
No one's as negative.
You know, we are great believers that people are still going to get up in the morning and start their car and cook their breakfast. And we've got growing population in Australia and also in the US, which we think is an important factor when it comes to growth and optimism. And the US, for instance, is just growing in a straight line at about 0.75%, 0.8% per annum. Australia's got good growth from immigration. So we see those as positive additives to GDP, and we think, with ups and downs, obviously with outside influences, we don't see too many disasters occur.
And it seems to me that while interest rates are as low as they are now, it's kind of like it's going to be a really massive curveball to create a recession with interest rates so low.
Yeah, well, I think that's true. But, I mean, as some of these people say, if we do get one, what are they going to do now? It's almost as though there's this big cloud of doom that's hovering over all of the markets and people are just waiting for the next thing to go wrong. But, look, I think there's a big nexus which never used to exist between, for instance, US interest rates and European interest rates and Japanese interest rates. I mean, it's very clear to us that interest rates in the US are trading far more off what's happening in Europe and those weaker economies we put up there than they are trading on the fundamentals in the US.
Which is quite extraordinary, isn't it?
Well, it is, and we expect to see that break in the next year. I mean, we think that puts an enormous amount of risk for those people who are choosing to invest in what's known as a safe haven, because those safe havens have now become more expensive than they've ever been. And if the economies are growing and we don't need to hide behind a rock, well, we might find that the price of those havens starts to drop.
Well done, Phil. Thanks for joining us. That's Phil Carden from Supervised High Yield Fund, or Supervised Investments Australia.